thank you to EconPol for the organization of this conference and having myself here for the keynote speaker. Also, thank you very much to our host from the permanent representation of the state of Bavaria. In the list of jobs that I currently hold, the one that really can explain why I'm going to be focusing most of my presentation on a specific issue of banking union is that I'm also the member from Spain in the Economic and Financial Committee and the alternate at the Eurogroup and the ECOFIN. So in this domain is where I think my contribution can be more interesting and probably some more useful, original or inside information from for your side. Because I agree with what you said in the beginning, in the introduction, which is the fact that, well, definitely from what our host said, there's a clear trend in the world economy. We see how Europe has been doing, how China has been doing in recent years. And there's an issue in Europe. I will be dealing with it. I mean, the issue of competitiveness of Europe is so extensively that we could be focusing on and looking at it from many angles. I will look at it from the financial architecture of the Eurozone particularly, because I also think that this is an angle that has an impact, not only in terms of economic and financial stability, which is the way we usually look at it, but also because of in the way the European economy works in terms of efficiency of in the end competitiveness. So I hope you can find also some of these comments interesting and relevant for the whole view that the conference and the different panels will provide over the course of these 2 days. So let's start with the obvious, which is the fact that something that has been mentioned by our host, that the European economy is facing an internationally challenging environment. In many sense, we have been talking about trade tensions for a number of years already. We have seen some emerging economies of a large scale going through troubles over the last couple of years. I don't know, like Turkey, like more recently also Argentina. We see some building geopolitical tensions in the Middle East, and here in Europe we have the still open issue of Brexit. Of all these challenges, clearly the trade, the international trade one is the one which is having an impact already, because it's not a matter of uncertainty as it was the case probably in the beginning a year and a half ago. It is also the case of some effective measures that have been adopted by the different counterparties that are already having an impact in trade flows, in global value chains. So, I mean, according to international institutions, it is already having an impact this year in GDP. So, according to the IMF, for instance, is somewhere between 0.8%, 1% of world GDP, which is going down because of this factor. And the key thing here is that it's not just what has been done so far. It is also the fact that we are not still out of the cloud. So there is still some uncertainty that has an impact in investment decisions, and that is, creating still some problems in the world economy. That explains why we have seen recently a revision downwards of the forecast for the world economy and for international trade in the recent annual meetings of IMF and World Bank. So the picture out there is clearly challenging. We have to also try to fine-tune a little bit our message, because the fact is true that there has been a revision downwards in terms of growth, but it's still significant growth. We're going to post, according to IMF, a growth rate of somewhere around 3% this year, which is the lowest since we got out of the crisis. But on a historical trend, it's not that bad. But the key thing is that there's already a clear impact this year in terms of the rate of growth of international trade, and here we can see that really there's something happening that should lead to some action. And I think in my opinion, what we have also stressed here at the different forum in Europe is that the response is more multilateralism, is not more protectionism. So one key and easy and obvious message is that from our side in Europe, to deal with these trade tensions, the only recipe is a trade and multilateral fair framework. WTO probably has to be revised, but the way to handle these situations where we may have some unfair conditions for competition from different countries is not by raising tariff barriers. This is going even in a war situation from the one we had before. So here we have to the first challenge, which is to really see if our voice, the voice from Europe, is heard, and we can really push for a revision of the multilateralism framework for international trade. But we cannot only look outside for challenges outside of Europe. If we look inside Europe, we also have our own share of challenges. We have seen also a reduction in the rates of growth in our economy. The European Commission has just published today a revision of its forecast, the autumn forecast, and there is generalized a reduction of rate of growth compared to their preliminary, the spring forecast. So we also have an issue here, which is not only a result of trade tensions outside, although it's clear that it is having an impact, for instance, in some economies like Germany. But I think that it is important that we also look at it more from a longer-term perspective on how economic cycles work, which is we have so recent the vivid memories of the very deep crisis that now that we are having a slowdown in economy, we're not just talking about a natural evolution of the cycle. Very suddenly we have the media and anticipating a crisis like the one we had only 10 years ago, and it doesn't have to be like that. And actually, I dare to say that it's not going to be like that, because the fundamentals of the economy are completely different, both in the financial and in the budgetary side. So we should look at it with the necessary concern at the slowdown of growth, but we should try to react in a proportionate manner. And how to react? Well, there's one obvious issue here that has been also mentioned very extensively in different discussions here in the different economic fora of academics, but also in the ECOFIN or Eurogroup discussions, which is that investment is the key variable here that we should probably focus on, which is we need to invest, and we need to invest right. So we see that when we were mentioning before that Europe risk of falling behind other big economic partners like US or China is because we have this view that probably in some areas, like for instance digital transformations, we are all the fintech revolution and so on, we are falling a little bit behind, for instance, China or US, and here there's a need for a clear push from our side at all levels, not only in terms of investment, because it's probably the last stage where we should act, but also in those stages where we should act much earlier, like for instance education or universities, and I mean there's a lot to be done here to make sure that Europe doesn't fall behind, because what we want to do is to preserve also the role of Europe. It's clear that it's not a surprise that since the 80s, when Europe accounted for roughly a third of the world economy, until now we are accounting for a fifth or a sixth of the world economy. That's only natural, because there are some large parts of the world economy that have been developing, that were significantly underdeveloped compared to Europe, and that should increase their percentage. But we should not just accommodate to this current situation, and we should really try to be one of the leading partners in the world economy in the future. And here is where the debate that you're going to have these 2 days comes into force. I mean, there's a clear need for Europe to be competitive in all fronts to face the increasing challenges. And here is where I am going to present more in depth the need for deepening of the European Monetary Union, and as one of the elements that can help build a truly efficient and integrated economy in Europe, as one of the reasons that could in the end contribute to increase the competitiveness of Europe. So from this introduction, what I take is the three key messages. So multilateralism on one side, investment on another, and then deepening of the EMU as one more area for us policymakers to work and to come to agreements to really see something happening sometime soon. A lot has been done already. I mean, not just the introduction of the euro, but over the early years of the crisis. Since the early years of the crisis, we have seen a significant improvement in terms of financial integration in Europe. We have seen something that before the crisis was probably inconceivable, which is a single supervision for the bank industry, single resolution mechanism. We have seen also some changes in the policy framework in Europe with the introduction, for instance, of the macro imbalances procedure to really address some of the questions that were at the core of the crisis. Some questions like, for instance, the fragility of the banking system in some countries that was, has gone unnoticed for some years. Some other issues like, for instance, significant imbalances in specific countries that were hidden by significant rate of growth. And here I know very well what I'm talking about, because coming from Spain, we've been posting huge current account deficits for several years that were considered not as such a big problem, because at that time Spain was growing very fast, creating a lot of employment and reducing its public deficit. But the truth is that there was a current account deficit close to 10% at one point, and the truth is that the level of particularly private debt was huge at that time. So I mean, some of these imbalances that in the end can have a systemic impact in the whole region are going to be much better monitored now with this macro imbalances procedure as they were before, and we are all feeling the pressure with the implementation of this procedure. But if we look more at the other domains of the financial integration that we have already seen, well, we saw, as I said, the big steps in favor for the banking union with the SSM, with the Single Resolution Board, and we saw the ESM. The ESM had a huge impact. I mean, and a huge role in the resolution of the crisis. It is very well known and well, very recognized the role that the ECB and Mario Draghi had, but we also have to acknowledge that the ESM was of paramount importance for addressing the problem of specific countries. And again, here my national experience as a Spaniard can clearly account for that, and because the dynamics of the crisis in Spain in 2012 changed very significantly when the ESM was developed and was announced and became a really effective and useful instrument for addressing the crisis that was particularly relevant in some of these countries, and that in some of the countries also in the case of Spain, that because of its size could have even a potentially systemic impact across Europe. So just to say that this debate of deepening EMU is something that we'll have with us for many years to come, but that a very relevant part of it is already up and running. But we need more, and why do we need more? I think that because we have to look at it from two angles, as I said also in the introduction. One of them is the traditional one, which is more of a defensive angle, which is how to cope with shocks, particularly asymmetric shocks in the Eurozone. The way the Eurozone has been designed, and this has been extensively documented by academics, has some weaknesses, and particularly is the absence of instruments to address asymmetric shocks. On one side, we don't have a financial market integrated enough to accommodate for this, to absorb these asymmetric shocks through the functioning of the financial markets, as is the case, for instance, in US. On the other side, also monetary policy has some limits here. First, we cannot accommodate the monetary policy to the specificities of a shock in one specific country. But also second, because as far as we have gone in terms of the use of monetary policy for addressing the difficulties of the European economy throughout the crisis, it is left with very little room of maneuver. So, I mean, and this has been clearly stated also by the ECB in their recent communications, that there's a willingness to have an accommodative monetary policy to support growth, to help growth, but that there is need for additional efforts. And here the efforts have to come probably from two sides. One is the fiscal side, another is structural reforms. From the fiscal side, the way the Eurozone is designed has also some weaknesses, because there is too much reliance on the solution on the first line of defense at the national level, and there's a lack of mechanism that could promote some sort of solidarity to a large extent that what we have seen in recent years across countries. So in the end, if we don't have exchange rate, we don't have monetary policy, we don't have a fully integrated financial markets, then most of the burden of adjustment falls under the national fiscal policy. And in times when the crisis is already there, this can be particularly challenging, because we would enter in extremely pro-cyclical policies, because what we've seen throughout the crisis, that the adjustment that those economies in the war situation had to go through really intensified the degree of the crisis in the economy. That's it's not to go against fiscal consolidation. Don't get me wrong. In the long term, fiscal consolidation, fiscal stability, and responsibility are essential. But once the crisis has started, there has to be some additional mechanism, not to let all the burden fall on the national fiscal policies, because, as I said before, this tends to be pro-cyclical, as we saw in the early years of the crisis, and it's probably better, more smoothing a little bit the adjustment to limit the impact that this can have in terms of growth and employment. But as I said before, this is one of the angles of deepening the EMU. There's another which is not as defensive. Is more in terms of how important it is for really having a truly integrated market in Europe for financial services, and that our economies are really integrated, and that our asymmetric shocks can be dealt with through solidarity and some specific instruments. This way we could have a more efficient and productive economy in Europe. We will see it here more later from the angle of the financial industry, but the more efficient the financial industry, the financial services are, the more efficient the whole economy can be. So we think that this efficiency in terms of the financial systems, the financial services in Europe, is again of paramount importance for the competitiveness of Europe. So I mentioned before some of the issues where we have seen already significant steps forward in terms of deepening of the EMU. We know that there are some other issues where there has been discussion in recent years, where a reasonable level of consensus has been built, and where we should see decisions probably at the next Eurogroup, hopefully, or Eurogroup in inclusive format, which is how we deal with these issues in December. And they refer mostly to the reform of the ESM. The ESM, as I said before, played a key role in the resolution of the crisis, but the truth is that it was designed, it was built at full speed at the same time as the crisis was unfolding. So it's good that we have had some time for rethinking and the role that the ESM has to play and adjusting its mandate. So, as probably most of you already know, some decisions have been adopted in terms of the reform of the ESM. One of them is that it will provide a backstop to the Single Resolution Fund to make the resolution scheme really effective and to give it the size and the firepower necessary for dealing with a banking system as large as the European. So first is the backstop. Then there's another very relevant issue that we only in the future we will see if we have been successful in the amendment of the ESM treaty, which is the redefinition of the precautionary instruments. There's a clear logic behind that. There's a clear logic behind the precautionary instruments, which is the way that it would be preferable to act before a country is in a situation unsustainable that can only lead to a program, to a fully fledged program. If we were able to identify some early signs of problems that could be dealt with some financial assistance that could relieve the pressure in the markets, for instance, and could preserve the market access for this country, that will serve the country because it will weather the storm more easily, but it will also serve the ESM and the whole mechanism because it will not be necessary to devote as many resources as is the case when the country is already in an unsustainable situation and a program is needed. So precautionary instruments were already designed in the early mandate of the ESM, but they were designed in a way that were not particularly useful when a real problem arose. We have amended these precautionary instruments, and as you know how these things go in the negotiation in the European, here in the Eurogroup, in the Eurogroup inclusive format, or in the ECOFIN, discussions have been complicated. We have come up with a proposal that is not exactly what some of us wanted. We wanted instruments that were more easily accessible for countries in a difficult situation. We have somewhat of a compromise, which is always the case, with the view from other countries that were specifically, particularly restrictive in terms of having access to these instruments. So I hope they are not necessary, but in the coming years, if one country goes through some challenging situation, I hope we can really make use of these revised precautionary instruments. But to sum up, this is the second main line of change of the treaty. Another one is reinforcing the role of the ESM and its capacities to have a better understanding of the situation of the different economies and be in a better situation to act when needed, but always assuming that it's going to be a joint work with the European Commission. And probably these are the main three lines of reform of the ESM that hopefully can be agreed in December, because there are just the final details to be cleared in the coming weeks. There's something else where we have seen some progress throughout this year, which deals with the fiscal side, not with the financial side of deepening EMU, which is a specific budgetary instrument for convergence and competitiveness in the Eurozone, the so-called BIC. This is, a project still in the making, but we have already identified, and there has been a consensus and agreement in the Eurogroup inclusive format on the main features of this instrument that will now be part of the global discussion of the multilateral financial framework. But that can, even being a small instrument, can be kind of the first step towards something that can, in the end, complement this lack of fiscal solidarity in the Eurozone. The BIC will be a standalone instrument that will be addressing, providing funds for investment and reform, and that will have a design that will make it some sort of counter-cyclical, so and here is where the final details will be designed in the coming months, will allow for some sort of convergence along the cycles to limit the impact of potential crisis across countries. But again, here we are just at the early stages of the development of this instrument. That's why I'm saying that there's this deepening of the EMU is a continuous process that started during the crisis, that has continued after the crisis, and that has to continue still in many years ahead. Now we are facing several challenges. We have to close the reform of the ESM treaty, but as I said before, this is we're almost there. It would be a surprise that there are major problems here in December. But we have to keep making progress on three different lines. One is banking union, another is capital markets union, another is again fiscal solidarity. With regards to the banking union, well, it has been going on for so many years that sometimes you can lose a little bit track of how this process is going. Originally, we had this clear view, clear definition of a banking union through the three pillars, through banking supervision, single banking supervision, single bank resolution, and a common deposit insurance. Out of these three pillars, in the first two were clearly, were successfully implemented. As I will mention later, probably there's room for improvement in the definition of these two pillars, but they're already there, and they are a major breakthrough in terms of integration in the Eurozone. The deposit insurance scheme was left behind, and for several years there was kind of a recurring request by some member states to complete the three pillars and move with the third one, with the continuous also opposition from other member states. So in the end, year after year, we were making no progress. And we could have a proposal by the Commission, as was the case in 2015. We could then have another one in 2017, but there was no consensus around the table. From this three-pillar approach and the continuous pressure from some countries to implement the missing pillar, we moved to another kind of debate, which was, okay, let's move towards deposit insurance, but only after some additional risk reduction measures have been adopted, which is kind of complementing this the dichotomy between risk sharing and risk reduction. Again, this dichotomy led to some sort of a deadlock, because there was a point when those asking for risk sharing thought that there had already been enough risk reductions. Those who opposed the risk sharing considered that risk reduction was not enough. So again, we were basically the situation where we were last year, back in 2018, is that there was no way to really see any way to make any progress on banking union, because we couldn't make any progress on deposit insurance. Some additional risk reduction was not accepted by others because there was no deposit insurance. So at this point, there has been kind of a change in the paradigm of the negotiation. So it's more what we can call a package paradigm. So early this year, there was this view from the Eurogroup and the Eurogroup inclusive, that instead of focusing in one specific missing part of the banking union, instead of debating risk sharing, risk reduction, because we all should be in favor of both, of risk sharing and risk reduction, we should look at the banking union with a broader view. And that's the exercise we undertook over the last the first six months of the year. In this first semester, there was a mandate by the Eurogroup to create a high-level working group to make progress on EDIS, but with a clear view that it was not just EDIS. It was a mandate, and that's the way it was defined, to look at a broader view of what was missing on the banking union and how we could make progress in this direction. So there was a technical group that was co-chaired, which was a kind of a new experience, and it was co-chaired by my German colleague, Jörg Cookies, and myself. So there was kind of these two views around the table. Usually Spain and Germany are not always completely aligned, so it was perceived that maybe by combining these two views as co-chairs, this could help build some compromise on such a contentious project. What we did over the course of these first 6 months is, with the support of the Commission, define the main missing pieces of banking union with a broader view, which is do not just look at deposit, do not only look at the recent dichotomy between deposit insurance and sovereign exposure, for instance. That has been also one of the trade-offs that has led nowhere. It's look broader. So basically, where do you see the banking union in the steady state? Are there any common views around the table among all the member states on how they would like the banking union to look in X number of years? And based on a original proposal by the Commission, we saw that there were some common views around the table. There was also a lot of dissent in some of these issues. But after we held some meetings and discussions, we came up with some sort of building blocks for kind of the next stage of banking union that were just to simplify a little bit, because there's a lot behind it, as you can imagine. But these building blocks were, first, one of them was how to deal with market fragmentation, because this is basically the core of what you're looking for when you are trying to integrate the banking system in Europe, is what's fragmenting the banking industry in Europe. Well, there are many issues. This is an open issue, because for some countries there is a clear problem of fragmentation. For others, this is not the main problem, but there are issues around fragmentation where we can make some progress. And here we should try to see how we accommodate the different views around the table. And on one side, we have to probably review what the national specificities are there and which of them are justified. We should also look into the very tricky issue of the home-host balance, because here we have to combine the need for an integrated banking system that could help promote cross-border business, cross-border banks in Europe. In terms of size, will probably have an impact, also in terms of efficiency. But at the same time, we have to make sure that nothing is changed that can put in danger the financial stability of the host countries. So I mean, not an easy task, as you can imagine, but at least we have identified one of these four building blocks. This first one is market fragmentation. Another one of these four building blocks is crisis management. So yeah, we have a resolution scheme in Europe, but is it really functional? The perception after a few years of having the SRB in place is that probably there are some issues that can be addressed to make the resolution scheme more effective, and they are not obvious. I mean, we're going to address some of them in the BRRD2, but I think there are still more thoughts to be given to really how we can define a resolution scheme that can provide the right answers when necessary, because we have seen over the course of the last few years that whenever there was an issue in the bank with a bank in one specific countries, the decisions adopted were not always the same, or were not always consistent with the direct implementation of BRRD. And the crisis management is not only about resolution, it's also about insolvency. And here we also see that there is a different landscape depending on which country you're looking for. So some sort of harmonization in the process of bank insolvency can be useful. In some cases, in some countries, we have a bank insolvency regime which is no different from insolvency regime for any industry, any other company in the country. In some other cases, we have specific insolvency regimes for banks, but they are very different from one member state to another. So here, in terms of crisis management, we have to probably make some progress in terms of making a more effective, adopting a more effective system, and also a more harmonized. So we had market fragmentation, crisis management. We have deposit insurance, of course. Deposit insurance can play a role also with regards to the other two building blocks in terms of reducing market fragmentation. Obviously, if we have a common deposit insurance, this will eliminate one of the differences for banks across countries, and it can also help the insolvency case for banks across Europe if we have a common system for handling depositor protections in Europe. Here, with regards to deposit insurance, as I said before, we had this first semester, and here I'm providing some inside information, but no confidential at all. But just to illustrate how we are handling this whole process internally in the Eurogroup and the EFC meeting and the high-level working group is, from this preliminary diagnosis that we obtained over the course of the first semester of this group that was co-chaired between Jörg and myself, we have moved to a second stage where we have created 3 specific subgroups. One of them is the one chaired by Jörg that deals with the first 2 building blocks, which are crisis management and market fragmentation. And another is the one I chair, which deals with deposit insurance, and where I've seen clear consensus on some very basic ideas. For instance, the basic idea is that we should try to ensure the same level of protection for depositors across Europe, irrespective of the size of the bank or the country where the bank is located. So this is a common view. How we achieve that? Then we have an issue. And clearly 2 confronting views. We have a view that in the end, the most effective way to do that is through a fully fledged common deposit scheme, which is basically one single deposit guarantee fund across Europe, which is 100%. And there's a mutualization, and there's another view, which is we don't have to go that far. We can use the existing national deposit insurance schemes and look for some way of interoperability among them and make sure that you can reach the final goal without really 100% mutualization. So there is still some agreement on the very basic ideas, and there's no agreement on how we're going to make it look in the end. I mentioned before these 4 building blocks and 3 subgroups, and the third subgroup is the one dealing with sovereign exposures and how to break the very famous doom loop between banks and sovereigns. This is chaired by Per Callesen from the Central Bank of Denmark, and well, the way we're going to proceed is that at the end of this year, hopefully next month, the 3 subgroups will report our progress to the high-level working group, which is basically the same formation as the Euro working group in inclusive format. So all European member states except UK. And from there we will see, hopefully, if we can agree on some sort of a roadmap for making progress in the coming years. And the key thing behind this package approach is that all progress has to be gradual and proportionate. So none of us should expect to see in the package only what we like. We'll have to see in the package what we like and what we don't like as much, but provided that the package is better than the current situation. And to get there, we will probably see some very gradual evolution in coming years as we see some political discussions. But at least compared to the situation where we were before, where there were just red lines across different member states and where there was no clear view on really how to move forward and potentially a complete deadlock, we see some lights of hope here. So we'll see how we close this year with these 3 subgroups experience, and then we'll see what comes next year, hopefully with a more or less clear roadmap for political discussions. Well, this refers to banking union, which is where we at the Eurogroup or the different groups below it, we have been working more intensively. But there is another issue where we have to make huge progress in the coming years, which is capital markets union, and they both go hand in hand. So we should only expect to make progress in both of these domains. And here, the Commission presented a list of proposals in their previous mandate, and most of them have been, successfully adopted. But I mean, in some of these proposals were watered down over the course of the negotiation, and the perception is that clearly there's need of what they say in the Commission as a reboot of capital markets union, and this is also the view of member states, and I'm not talking just about Spain. I mean, when you hear other member states in the fora, we are all in favor of giving another thought to and another try to capital markets union, another thought to come up with some new proposals and then try to be ambitious from our side, also from the Parliament, to deliver on something that can really have an impact and help us deliver on a really integrated capital markets that is going to be key for the efficiency and competition in Europe and of our companies. We already had the results from next CMU high-level working group on capital markets union. So this by a group of experts that already delivered some recommendations. Now the Commission is putting in place another expert group with some more specific mandates, in a sense of following also the idea of 3 specific subgroups. The way I see it is that it is probably a less clear a project than banking union. It has even more angles to look at, so it's difficult to really visualize really where we're going to end and what are the measures that have to be adopted to get there. Some of the most obvious issues that have to be addressed for making progress in capital markets union are, of course, improving the funding conditions for companies across Europe. So the more you integrate the capital markets across Europe, the better funding conditions hopefully should have European companies, and particularly SMEs that are usually more limited to the funding conditions that they can find at their home state. Also, to increase the investment opportunities across Europe, maybe with the design of new products that can be more interesting. There has been some attempts to that in the previous Commission mandate with securitization, but here there is still more to be done to develop again a market for securitization and also for cover bonds that can be effective, but that can provide at the same time the necessary level of protection for investors. And last, it's not only about savings, it's not only about investment, it's also about market structure. So we have to make sure that there is a real competition and you have a real effective channels for investment savings to move across Europe with more of efficiency for efficiency reasons, no, because of the regulations of some barriers to competition. As I said before, when looking forward in the deepening of the EMU, we shouldn't look only at banking union or capital markets union. We should also look at the fiscal angle in terms of fiscal solidarity. Here, I mentioned the BIC, the Budgetary Instrument for Convergence and Compliance, and Convergence and Competitiveness. And I mean, there's a lot to be done over the course of this next year, 2020. We have to work on the details. We have to agree if there's going to be intergovernmental agreement on top of the BIC that can increase the funds that the BIC can in the end manage, because given the size of the European economy, the amount of money that the BIC is going to deploy is clearly insufficient for having an impact. And so, in case of need, probably this intergovernmental agreement could be the only way to make it really an effective tool. There are other instruments out there that are worth considering. For instance, and that have been mentioned extensively in over the last few months. For instance, some sort of a reinsurance unemployment scheme. Being unemployment one of the traditional sources of fiscal tension in a country in times of crisis, so some alternatives for alleviating to a certain extent the pressure that these countries can have during the crisis through some transfers or just simply loans can be useful. We think that in the end some of these instruments can be a way to regain some confidence by the European citizens that sometimes may perceive that discussion around deepening the EMU is way beyond their interest. For instance, when we talk about backstop, when we talk about the precautionary instruments, these are probably not instruments that they perceive can be useful for themselves. But when we talk about a common unemployment insurance scheme, probably they can really think that we are considering some options that can have an impact not only at the terms of the financial macrostructure or balances, but also at the time of at the level of the citizens. I've mentioned 3 areas that are difficult enough in terms of deepening EMU, banking union, capital markets union, and fiscal solidarity. But they are not the only ones. There are others that are even more contentious than this one. For instance, in terms of if we talk about tax harmonization, if we talk about insolvency regimes, if we talk about AML, I mean, these whole issues are going to also play a role in years to come. But the truth is that although I think that the package approach that we are using for banking union can work, has proven has given some results. If we put too many conditions before moving forward, we risk of getting into another deadlock. But I just wanted to mention these issues because these are, the tax issues and insolvency regimes have to be addressed in due time with the necessary negotiation, but are going to play a role to really ensure a level playing field across the Eurozone. I think I've covered most of what I was planning to say. I want to recap and say that irrespective of the international challenges, in Europe we have our own challenges. We have to deliver as quickly as possible. And as a policymaker, in my role, I think that where we can deliver is really promoting, for instance, in this domain, a bigger integration. I think it's going to be for the benefits of not just our banks, but for the benefit of the whole European economy and for the benefit of the European citizens, and should in the end put Europe in a better situation for competing in this new economic world. Thank you very much.
Okay, thank you very much. I think this was really a fascinating insight into what's going on and the negotiations. So we have 10 minutes for questions. Would that be okay?
That would be okay.
Or comments. There's one in the back. If you please shortly introduce yourself. Get the mic.
Thank you. My name is Giovanni Ferri. I teach at Luisa University in Rome. And my question is, we have heard from the new Commission about the Green New Deal, and I wonder whether you have a view on the fact of whether it could provide an opportunity to expand the capital markets union.
We take another 2 or 3 questions, maybe.
Markus Kerber from Berlin Technology University. I have 2 questions, not without mentioning that I listened to your proposals with great surprise, because there are 2 points which I find particularly thought-provoking. The first one is that you propose, or in the list of proposals you mentioned, the enlargement of precautionary instruments for ESM. This brings you into obvious conflict with the principle of conditionality, enshrined not only in the statutes of ESM, but in the treaty itself, Article 136. No financial stability support without conditionality. The more you make these instruments precautionary, the more you disconnect them from conditionality. Second remark concerns your, I would say, wishful thinking about using ESM as a backstop for the Single Resolution Fund. As you probably know, as you quite certainly know, the ESM is not supposed, it's not allowed to give financial support to EU institutions. It's only supposed or allowed to give support to countries. So there you have clearly to respect a red line. Could you comment on that and about the feasibility about your proposals? The legal feasibility, I don't want to mention the economic sense of your proposals.
We'll take those two together.
Well, very briefly, with the first question, I agree that the Green New Deal and all the huge amount of investment that has to be channeled to for climate issues will benefit a lot if we have really this capital markets union. Will play a role in how investment funds are channeled across Europe, and it's going to be one of the key issues of probably this reboot of capital markets union, to really how effective this can be in channeling the necessary funds to the new request from the transformation of the economy, not only in terms of green investment, but also in terms of technological transformation. So there's also going to be a need of huge investment in terms of innovation, and here the CMU, the Capital Markets Union, can play a role. With regards to the other also provocative questions, I see your point, but the truth is that that's why a change of the treaty is necessary. A change of the treaty of the ESM is necessary for it to provide a backstop for the SRF, because that's the way it's going to work. The ESM, under certain conditions, can provide a backstop if the SRF is depleted, so the backstop will be provided to the SRB. And I can assure you that this has gone through all the legal scrutiny as necessary, but by all the legal counsel services in the Commission and the Commission and the ESM itself and in the Council. And then the enlargement of precautionary instrument is, we already have precautionary instruments before. So it's the fact is that how accessible these precautionary instruments are. Depending on the type of instrument you're using, you may need a memorandum of understanding that will embed some conditionality, or you will simply need some sort of an agreement that would also imply some conditionality, but it will not be the same as the full range of conditionality that a program will carry. And a program is not only in terms of higher conditionality, but also in terms of some sort of stigmatization that has a political impact at the country which is looking for it, or that may need it, that may postpone the decision. So if we were able to design a product that has less of a stigma, which make it easier for a government to gain access to this instrument, and that can provide the necessary reassurance to the lenders. Here is the ESM, and behind the ESM are all member states that this loan is going to be reimbursed. Then let's make it work. But the problem is that if we put the same level of conditionality to a precautionary program than to a program, then, the precautionary instrument than to a program, then there's no difference, and in the end, all we're going to have are programs.
There's one question over there, please.
And there's another there, and then you can call.
Thank you. You mentioned the importance of deepening the capital markets union. And my question is, are you optimistic that the European Commission is on the right track with the view of a new trade agreement with the UK after the Brexit, taking into account the breakdown of the negotiations with Switzerland and the impossibility to buy Swiss stocks on EU capital markets? So the capital market is taken as a hostage of maybe broader political goals. Or don't you think so?
Then I would suggest we take 3 questions this time, and then we wrap it
And
up.
then we wrap it.
Yeah, please. There was one question here.
Gerhard Stahl, Peking University HSBC Business School. My question refers to the international role of the euro and whether this is an issue which has raised some discussions also inside the ECOFIN and between member states. We have seen that the Commission has presented a communication about the increased role of the euro in the international area. We can see that Russia is replacing the dollar by the euro in trade agreements, and we can see that China is using the One Belt, One Road initiative to promote the use of the yen. Has there been a discussion also about the international role of the euro inside the ECOFIN and euro contexts?
Can I add a final question? It's a more technical one on deposit insurance. Let's assume we have another crisis, hopefully not as bad as the last one, and the denomination risk returns. Okay, so one of the objectives of deposit insurance is to make sure we don't get a run just because of the denomination risk, right? But then the question will come up, okay, the new deposit insurance, will it pay out in euros if a country leaves? And if the answer is no, it doesn't fulfill its functions, because you don't stop the run if the answer is no. If the answer is yes, you have something which is politically impossible. So a country leaves, we remember the debates about Italy. A country leaves, and then the message is, okay, we still pay out in euros. So I see a dilemma here, which is, one way of dealing with it is just to ignore it and hope it never comes up, but it will come up in the crisis. So what are the ideas about that?
Okay, so I see that the questions are turning more difficult than the presentation itself, which was my my concern before. So for the first question, it's difficult to answer. Really, I will be naive here. I hope that in the negotiation with the UK there is no, too much tacticism affecting capital markets, because this can be disruptive and can have a clear impact. So obviously the better situation is the one we have now with the UK, but we have to face that it has to change, and well, we have to see how it is, how the new relationship works. For the benefit of all of us. I'm not in a position to really say something very concrete here, also because the negotiation with UK in the coming years will be again the package deal. So to get something on services or on trade, we will have to see how much we can get on capital markets, and our own message from our side in our part of the business, which is the one dealing more with financial matters. Our concern is that the final outcome is not disruptive at all, and we can have some graduality and well, the decisions that have been adopted in previous months to face a potentially challenging no deal agreement have been successful. Where in terms of, for instance, market infrastructure, how you deal with here we've had some decisions by the Commission that have helped weather this whole thing. So far, it hasn't had a major disruptive impact. The banks have been gradually adapting, the financial industry in general. But definitely we're not there. We're not in the steady state. So from our side, what we can say probably at the EFC or at the Eurogroup is to come up with a solution that creates as little waves in the capital markets as possible. But then there are, higher interest in the whole negotiation. The international role of the euro has been extensively discussed in the ECOFIN and in the Eurogroup, and we had this proposal by the Commission. it is really considered as a strategic issue, and we expect that the new Commission will come also with some additional and more concrete proposals. Here, there is in the discussion there's a kind of a dilemma. In a sense, you say, okay, in the end, it's a decision that to be adopted by private practitioners, so there's not much you can do there. On the other side, if you do something at home, for instance, in terms of building a really effective capital markets union, of, for instance, something I didn't mention before, but having some sort of a safe asset which is liquid enough, this could also help improving increasing the international role of the euro. The ECB has also presented some statistics showing that we are now a little bit better than we were in the worst years of the crisis in terms of use of the euro, but there's more to do. So I guess we have discussed extensively, and we will keep on discussing before probably some specific measures are adopted. And there is a limited scope for decisions in the specific domain of the use of the euro. It's more probably on indirect issues that can in the end affect the use of the euro, like capital markets union. Then the last question, honestly, it's an impossible one to answer. I mean, I would like to think that the redomination risk is something of the past. We'll see what the future may bring, and if this is the case, then the deposit insurance, I don't know if this is a flexibility that should be already incorporated when designing it, but I mean, there would be a way to deal with countries that would potentially leave the euro. But the truth is that we don't expect countries to leave the euro. We expect countries to join the euro, and as you know, there are a couple of countries in line to join the euro, and if we were successful in all these projects, the banking union, capital markets union, probably we will end up having really more countries joining the euro, and we will finally succeed with this whole process. Thank you very much.
Great outlook. Thank you. Very optimistic.
Yeah.
Great. Thank you very much.
Okay. My pleasure.
Thank you very much for being here.
My pleasure.
We have a coffee break now, and then the next keynote by Daniel Gros. So see you in 30 minutes. Thank you.